On behalf of Mr. Chandrakant Salunkhe, founder and president, Maharashtra Industry Development Association and SME Chamber of India, I would like to welcome you all to the CEO Roundtable on Future of Credit, Unlocking Possibilities with Technology, organized jointly with UB, formerly Cred Avenue. Maharashtra Industry Development Association has been founded by Mr. Chandrakant Salunkhe and is functioning for the last 25 years for the industrial and economic growth of the state. MIDA, being the leading advocacy and lobbying organization of the state, acts as a think tank to provide useful and necessary inputs and suggestions to the state and central governments, corporates, MNCs, banks, financial institutions, regulatory authorities, and government agencies to provide level playing fields and secure the interests of the industries in ease of doing business. UB is a principal partner of this event and it is India's largest debt platform which enables discovery, investment and fulfillment of credit. UB aims to collaborate with the companies that make an impact on the nation's economy, and they have worked with more than 3,000 enterprises across different credit ratings to help grow this vision. UB Loans is one such product which has helped them to take the leap to reaching this goal. This fully integrated platform hosts 750 plus lenders and has facilitated more than 10,000 crores of loans. Another such product of UB Flow is India's largest supply chain finance platform, which has financed supply chains across 11 sectors and disbursed more than 1,500 crores of capital, trade and supply chain finance platform for corporates and lenders, fixed income securities, platform for institutional retail investors, loan co-origination platform for banks, NBFCs, and fintech and end-to-end securitization platform for banks and NBFCs. The exclusive event will see the stalwarts from the financial industry to discuss the deliberate on the topic and talk about the way forward. Now, I would like to invite the following dignitaries on the dais. Mr. Chandrakant Salunkhe, Founder President, Maharashtra Industry Development Association and SME Chamber of India. Welcome, sir. Mr. Madan Sabnavis, Chief Economist, Bank of Baroda. Welcome, sir. Please have a seat. Mr. Surjit Das, Chief Business Officer, UB Flow. Please give a big round of applause. Sir, please have a seat. Mr. Dhaval Vikamse, Head Client Acquisition, UB. I welcome you all. Now I would like to invite Mr. Dhaval Vikamse, UB, to give the token of appreciation to Mr. Madan Sabnavis, Chief Economist, Bank of Baroda. Also, I would request Mr. Dhaval to please give the token of economy to Mr. Chandrakant Salunkhe, Founder President, Maharashtra Industry Development Association and SME Chamber of India. Now I would like to request Mr. Chandrakant Salunkhe for the welcome and introductory speech.
Good morning. I always say थोड़ी आवाज आनी चाहिए तो मोदी जी इसको सुनना चाहिए ना, तो हम फ्यूचर ऑफ क्रेडिट की बात कर रहे हैं तो लेट हिम अंडरस्टैंड नो. On behalf of Maharashtra Industry and Development Association and SME Chamber of India, it's my immense pleasure to welcome Sri Madanji, which is providing valuable support, valuable knowledge, valuable hand-holding through Bank of Baroda to all of us. Dhavalji, Surjitji, my friend Sinkarji, Sudesh Vaidya, Kulkarni, and all friends from the industry, and especially for the came here to understand what is the future of credit, unlocking the possibilities with the technology. We have here Ashok Shahji also from the one of the largest industry, logistics and supply chain. Welcome, Ashok bhai. My friend Alok ji is also here from Kotak IndusInd Bank, who is going to speak about particularly how this banking system is providing support to industry, particularly manufacturing industry, for better business growth. Friends, we are aware that during the pandemic, only banks have saved us and government saved us. All the banks provided valuable support to manufacturing industry, especially in SME sector. And bank and government also realize that how they are facing difficulties to reach the SME sector and particularly manufacturing industry. During the pandemic, each bank officer tried to reach the industry and understanding properly how they can enhance credit facilities more and more to manufacturing industry, especially for the exporters and service industry. And I realized that time why the banks are not reaching properly to the manufacturing industry and SME sector. Before pandemic, there were, I think, 49 lakh MSMEs were a customer of various banks. Now it is enhanced to up to 99 lakhs. Because of emergency loans. So entrepreneurs and the manufacturing industry understand that getting bank finance or getting bank support is always best during the difficult time. So they have approached banks and they have started getting the support. But now the UB has come out with a very, very unique platform, and they are providing support to those companies, those manufacturing industries or SMEs struggling to connect to the banks at a larger level also. And today's seminar or other roundtable meeting will give you insight what the UB is going to present you, what UB is going to play an important role in the market, and how they are going to provide a support, a technology support, a technology platform where SME sector or manufacturing industry will get advantages. I always discuss with the governor of RBI about how they can enhance the credit facilities to industry on time, affordable, and always I ask the question to RBI governor and finance ministry when the rate of interest will come down at least up to 500%. So every day I'm just looking at the newspaper that 5% तो rate of interest कम होने के chances है अशोक भाई, तो दिखाई नहीं दे रहा है, but वो भी दिन आ जाएगा क्योंकि we are competing with the world market, and I know the banker will explain about why the bank interest rate is not coming down and how this will be happen in future. That is also interest. The next 22nd November, we are having monetary policy review committee meeting with the RBI governor, and there also I am going to present a lot of issues and problems. So Madanji, if you can share some of your ideas, thoughts, particularly on the industry perspective, manufacturing industry perspective, and especially for the MSMEs perspective, so that we can take up. So friends, I will not take much time, but I will be very happy to hear from the UB senior executives that what is their plans, their future plans, and their platform is going to provide the valuable services to industry, especially the manufacturing industry and the exporters, where they can take advantage and where they can enhance their business growth and enhance their credit worthiness, particularly for the lender's perspective. With these words, I'm thankful to UB for joining hands to present you the information about future of credit. The theme is unlocking possibility with the technology. So we have to hear from Madanji also what is his thoughts about particularly the India's economics, because India's economics depend on the manufacturing industry also and depend on all of you. If you will do some work, then Modi ji will think that my dream is going to be a success. So reaching $5 trillion economy, we have to work hard, and UB also work hard because they have to provide a valuable services to the industry. With these words, I'm thankful to all of you, and I welcome on behalf of MIDA and Chamber. Thank you.
Thank you, sir, for your encouraging words. Now, I would like to invite our first speaker, Mr. Madan Sabnavis, Chief Economist, Bank of Baroda, and his topic is India Economics, Preparation to Face Global Recession. Please, sir, welcome.
Yeah, good morning, everyone. And but first of all, I'd like to thank Mr. Solanki and UB for inviting me out here. Today, as we speak, there is a lot of noise, I would say, in terms of how the global economy is placed, how Indian economy is placed. I think all of you must be hearing of the fact that there is a global recession, which means some kind of a slowdown happening across the world. And in this kind of a doomsday situation, India is doing very well. Because if you go by any of the estimates of growth for the Indian economy this year, not necessarily what Indian organizations are saying, but if you go by what the IMF, the OECD, the World Bank, the ADB are saying, we're still looking at growth in the region of around 6.5, 6.8%. So if we look at 6.8% growth for the Indian economy this year, and maybe slightly lower at 6 to 6.5% in 2023-24, in an environment where the global economy is probably going to slow down to probably a low 2% next year. This year also we're talking of something in the region of around 2.5 to 3%. It does look that India is definitely an outlier in doing very well. So when we look at what officially we are told that the economy is doing very well, we are definitely the shining star, and India can take over the role of China, because we've seen that China has gone into a quagmire where the economy has slowed down, the investment-based model has stopped working. So we've realized that consumption is what's been driving an economy, which is not taking place in adequate numbers in China, and therefore there's a slowdown in China. Add to this the fact that China seems to be hyper about COVID. So anytime there's any news about COVID, there is a lockdown which is being imposed, which affects economic growth. And when China slows down and its growth is affected, the entire world economy starts getting affected, because China is a very large player in the global economy. So in this kind of a situation, probably with a touch of hubris, we say that, look, India can take over China, and the spot which has been left over by China can be taken on by India. So how exactly is one supposed to look at the situation? Because when we were analyzing the corporate results, for example, okay, for the second quarter of this particular year, the top line growth seems to be very, very impressive. We're talking of something like 30% growth on an aggregate basis. If I leave out the service sector, because the financial sector tends to perform very well. But if you look at just the manufacturing sector, I'm talking of 25 to 30% growth in top line. But when I look at the bottom line, I actually see that profits have come down. And almost the common feature in the commentary of all the CEOs who made their investor presentations is that we have been hit very hard by rising input costs. So inflation, which earlier seemed to be an issue which concerns economists, where we keep saying whether the number is going to be 7%, is it going to be 6.8%, 6.5%. Okay, that is more of an academic discussion whether we are above 6% or not. But at the end of the day, when we have inflation which is prevailing at the rate at which it is, because if you look at WPI, we are more or less in a double-digit number. The CPI is probably going to be 6.8% today, but still definitely above 6%. It means that everybody gets affected. See, as a consumer, all of us know when we go to the market, we are paying higher prices for almost any commodity, any service. Because after the lockdown, the service sector has opened up and everybody wants to recoup their losses, and therefore they have started increasing the prices, which means that we have generalized inflation. So what are we actually supposed to make out of this? See, on one hand, I would say that when we're talking of a recession, it is not technically a recession, because economists define a recession as a situation where we have 2 successive quarters of negative growth rate. Now, this happens in isolated instances. Probably it's happened in US in the first 2 quarters. It is felt that the Eurozone may be having negative growth rates in the third and fourth quarters. But on the whole, if you look at the overall economic growth of almost all the economies for 22-23, based on the World IMF data, we actually see there is positive growth. So we're actually not talking of a situation like 1930s, when we had a depression, negative growth rate, we have high levels of unemployment, prices have crashed. In fact, we have a fairly anomalous situation here where growth has slowed down. Unemployment actually is at one of the lowest levels in the US. So that's a very crazy thing, because when we talk of a recession, it should actually mean that people are losing the jobs. But if I look at the US, you're actually saying too many jobs are being created, and that's one of the reasons why the economy is overheating. And that's why the Federal Reserve is doing what it's doing. So let's first define saying that when it's recession, it's definitely not doomsday. We're not talking of negative growth rate. It's just a case of economic growth slowing down. So instead of having growth rates of 4 or 5% in the West, we are having growth rates in the region of maybe 1 or 2% on an average basis. And of course, the China factor, as I mentioned, China has slowed down, so it affects everyone because it's a large exporter, it's a large importer. So if China slows down and they stop importing goods, automatically the suppliers are going to get affected. So therefore, there is a second round effect of the slowdown in China on the rest of the world. So if we look at the Indian economy, why are we doing so well? We're doing very well because we are basically a domestic-oriented economy. So again, let's keep aside the noise where everybody says we'll take over China, we will do what Europe is doing, we'll do what US is doing. But at the end of the day, Indian economy is a domestic economy. So that has an advantage. When I say it has an advantage, because when there's a slowdown in the developed countries, we don't get affected that much. Because agricultural growth is production, consumption is primarily for domestic markets. Services, if I leave aside software, which doesn't get calculated as part of GDP, it's just for the information of the layman out here, software does very well, but it's not a part of GDP. Okay, it's a part of our balance of payments. It's as good as you sitting in the US and remitting $100 billion. That's what the software people are doing. So it's not a part of my GDP. So all my services are domestic oriented. If you look at manufacturing sector, yes, that's where we see a lot of exports, a lot of contribution coming from the SMEs. But if you look at exports to GDP ratio, it's definitely not comparable to what we see of the East Asian markets, or forget about even China. So that's one of the reasons that a big negative for us is actually a positive, that when I'm a domestic-oriented economy, where my reliance on exports is less than what it is for other countries like China, or even if I talk of countries like, say, Thailand, Korea, Indonesia, we tend to get less affected when there is a world crisis. So if we take it back towards the Lehman crisis, 2007, 2008, there was a talk of decoupling. Are the emerging markets decoupled from what's happening in the West? The answer was yes, and that was proved because primarily China was driving the entire world economy. But today, if I talk of a decoupling, I think there's been a lot of globalization which has taken place. And when I say globalization, that is the dependence, interdependence of countries on one another. So if US is going to slow down, China is going to slow down, most of the other countries are going to get affected. My GDP may be marginally affected. So if you look at the kind of estimates we had for GDP growth, even from the Reserve Bank of India, or we at Bank of Baroda, we started off at something like 7.5%. Today we're talking of something in the region of around 6.8 to 7% growth. So it's a marginal kind of an impact, but even a number of 6.8 or 6.5% will be very much impressive compared to the other countries, the other kind of growth rates we're seeing. Is that all which is there to this story of low growth in the Western economies? The answer is no, because when we are talking of a recession, we are also talking of the SMEs out here. SMEs are major contributors to our exports. So if I say that my exports are going to get affected, automatically the SME segment is going to get affected. Okay, we cannot wish away the fact that the SMEs are going to be very happy. Yes, there has been a lot of support which has come from the Reserve Bank, from the government, the ECLGS scheme. But when my main markets are not growing, then automatically there will be a hit. So to the extent that my export growth slows down, and the major contributor to exports are the SMEs, I think this is where it's going to be a pain point for all of us out here. Is that all? Because if you look at the larger companies, other kind of export markets, maybe if you're talking of your engineering companies at the higher end, you're talking of electronics at the higher end, those kind of exports may not really get affected. But I'm talking lower down the order, at the margin, there will be a lot of pain which will be there. And this is where I think it would be required for the government to take certain affirmative action to make sure that kind of protection which is provided to the SMEs has to prolong for a longer period of time. And here I think ECLGS, which has been one of the main programs which has worked very well during the COVID times, needs to get an extension, and we need to look at this particular sector closely. Now, surprisingly, not surprisingly, I would say interestingly, we had carried out a survey in Bank of Baroda among the SMEs. This was maybe in the month of around June, July. So we got the results by around August or so, as to how exactly have the SMEs faced post-COVID, how useful they found the ECLGS. And I think that the result was very heartening. Almost, I think the majority of them, 80 to 90%, felt that, look, the worst of COVID is really behind us. ECLGS really has helped us. We need, of course, an extension of this particular scheme. And there's obviously this always, I mean, everybody wants to pay lower interest rates when you're borrowing. And as deposit holders, we always want higher interest rates. I think that's the normal thing. But that was the general feedback gotten, that the SMEs had actually gotten out of the worst of it. This was before one really knew the gravity of the situation of a recession or a slowdown happening in the West. Because at that point of time, we had seen that commodity prices were going up, and commodity prices going up are normally associated with a booming global economy. So the world economy did very well in 2021. That's why commodity prices went up. But then we had the Ukraine war, we had the Federal Reserve step in. So I think Federal Reserve stepping in is the next point which we'll have to look at. Now, all through we have seen that the Reserve Bank of India has said that monetary policy decisions are based on domestic considerations, right? We see domestic inflation. The MPC has been told that you look at inflation, which should be within the range of 4 to 6%. We're above 6%, then you start increasing rates. You're less than 4%, you start, or less than 6%, you start decreasing rates. That was the general perception. And this is a view which the RBI has always held. Now, in the last policy, again, quite curiously, the RBI said that we have been subjected to 3 shocks. One was COVID. Second, they said, is Ukraine. And the third one is the Federal Reserve. So the first time, I think the RBI governor began his speech by, this is how he began his speech, by saying that we've had 3 shocks. The third shock is the Federal Reserve, which means that what the Federal Reserve does is going to have a bearing on our monetary policy. So I think, Mr. Salunke, you were talking about interest rates coming down to 5%. I think that's going to be a long dream. I mean, we can dream of it. It's not going to be a reality, because if you look at what the Federal Reserve is doing today, the market is getting paranoid about the language which is used by the Federal Reserve. We all know that, okay, it's gone up by 75 basis points. Next time could be, they're talking of something like 4.5, 4.6% will be the terminal rate. We all know it's going to go there, but the language seems to be very important. If the Federal Reserve gives an indication saying that we're going to get aggressive, the market gets spooked. When the market gets spooked, the stock indices go for a toss, currencies go for a toss, bond yields go for a toss. So we have seen commotion in the markets, all the 3 markets, the forex market, the bond market, as well as the stock markets, based on what the Federal Reserve not does, but what it says it could possibly do. So what is the Federal Reserve saying today? The Federal Reserve is saying that we're going to continue increasing rates. It may not be that as aggressive as what it was earlier, which means that rates are going to go up. Now, when rates go up, the question is that, should I really worry about it? Because if my inflation number, which was past 7% last month, is probably, even I believe, will come close to 6% by the end of March. And once we go into the new financial year, we'll be less than 6%. Then interest rates should logically come down. But that's not a view which can be taken today, because as long as the interest rates are high in the US, the ECB, the Bank of England, they're also going to keep increasing interest rates. And that's going to be affecting your overall investment flows. So this is another factor coming in. So one is the interest rates happening. So we have this anomaly saying there's a recession, inflation is high, yet unemployment is low. The US government, Federal Reserve, is trying to do something to make sure that there's cooling down of the economy. So you're actually pushing the country into a slowdown, because as I keep increasing interest rates, you're going to deliberately push the US economy closer towards a real recession. Now, how much will the Federal Reserve go is a matter of question. When will they stop? Will they stop this year? Will they stop next year? Because I'm quite sure they're also very intelligent people. They don't want the economy to get into negative growth rates because of federal rates going up. So at some point of time, there will be a kind of a pause taking place. But nonetheless, as long as the interest rates are high out there, investment flows get affected. So if I'm a person who's investing in the debt segment, I would say that, look, I'm getting very much better returns in the US or in the Western markets. Why should I come to the emerging markets? Now, if I take you back to Lehman crisis, we had a Lehman crisis. We had something called a QE, which came in. There was a lot of liquidity which was pushed into the system. The Federal Reserve did it, the ECB did it, the Bank of England did it. The whole idea was to make sure that there's lots of money available so that you can revive the economies. I would say a kind of a consequence which nobody thought was that a lot of this money which was given to revive the local economy actually went to the emerging markets. So when Indian stock markets did well, our FPI numbers went high. It was primarily because there was surplus money out there. Now today, think of a situation where the QE has ended. So right now there's no fresh money coming in. At some point of time when the debt matures, there will not be any further money being given. This means that emerging markets get affected. And today when we see FPI flows turning negative, it's a result of the fact that the amount of investable funds have come down, and automatically people take decisions saying that the interest rates are higher out there. Why should I be investing in a country like India? Or all the emerging markets for the matter. So this withdrawal of FPIs creates a problem again on our balance of payments. So today when we are saying that our currency is depreciating, one thing is to say that as long as Federal Reserve keeps increasing the rates, the dollar keeps strengthening. So the dollar has strengthened. And you must also have heard of the fact that we keep saying that India is the best performing currency, because if we see the depreciation of the rupee compared to the other currencies, India has done much better. We are probably at a median level, which means that when I have this process of Federal Reserve increasing rates, dollar is considered to be a strong currency, America is considered to be a good place investing. Automatically, when funds move out, our fundamentals get affected, as a result of which we have seen the rupee depreciate. So we have a problem on the currency front. So therefore, when you're looking at the RBI, what is the RBI supposed to do? We have seen that they have also followed a policy of reverse quantitative easing. So excess liquidity was in the region of around 6 to 7 lakh crores per day. Today, we have come almost close to a deficit in the last 1 month, which means that the bond yields have started going up. We have also seen that repo rate has gone up, and it's already reached 5.9%. And our guess is that we'll probably reach something like 6.5% by March. Okay, because just maybe a week back or so, the RBI had to give an explanation to the government. That is a mandatory thing, because the MPC has, in their own language, has failed to keep inflation below 6% for 3 quarters. So therefore, the RBI has given an explanation. And in a situation where you have given an explanation to the government as to why inflation is high and what it has been doing to control inflation, logically, you cannot stop increasing interest rates. So to my mind, I think when interest rates keep going up, they're going up to say 6.5%. As far as lending is concerned, if you look at SME lending, to my mind, you all can correct me, most of them are based to an external benchmark. Home loans are based on an external benchmark. So the moment my interest rate, which is charged on these loans, is linked to the repo rate, there's an automatic transmission which takes place. So I think when loans are being negotiated, one will have to be a bit careful about how these loans are reckoned, because the moment I say external benchmark, none of us knew the gravity of the situation when the concept of external benchmark came in. That when the repo rate suddenly shoots up by 190 basis points, the larger companies who are borrowing on the basis of MCLR actually are not facing a problem, because the MCLR has probably gone up around 45, 50 basis points. Whereas if I've taken a home loan, if an SME has taken a loan, you're not part of that ECLGS. You automatically say that it's loan, your existing rate plus 190 basis points. So overall cost of borrowing, to my mind, is going to be in a state of flux as long as interest rates are going up. So at least for the next 2 years, rather, let me say up to March 2024, for the entire 23-24, we will have to be prepared to live with higher interest rates. The same kind of increase may not be happening on the deposit rates. We have seen that deposit rates do not increase at the same rate. So today, if I look at 190 basis points, MCLR has gone up around 40 to 50 basis points. Deposit rates, average deposit rates have gone up around 25 to 30 basis points. So therefore, we will have to be prepared for a situation. So we all started off with a global recession, saying India is insulated, but we see there are lots of pain points for all of us out here, and including the banking sector, which, because of the way in which it's been structured, the way in which interest rates have been structured, we will have to be prepared for a regime of higher interest rates. And if you look at what most of the banks are doing is, this is not because I'm a part of a bank, but generally if you look at it, the view taken is, I mean, all of you just have to see how are the deposit rates moving. If banks are increasing deposit rates only for the 1 to 2 year brackets, which is what all banks are doing, most of the banks are doing, it means that it's a wait and watch policy being followed by banks. So I don't want to increase deposit rates, the interest in deposit rates, say for 3 years or 5 years, and get locked into a cost for this kind of a period. So most banks are sort of playing this hedge role by saying that we will increase the rates for a period of 1 to 2 years only, because it is expected that for this particular period, we would still be expecting interest rates to be where they are. And it's only after that that we could see the interest rates coming down. So in short, what are we saying? That while the global economy has definitely slowed down, Indian economy is not going to slow down numerically. We'll still be at 6 to 6.5, 7% growth rate. But however, if you look at all the markets, when I talk of the markets, bond market, currency markets, as well as stock markets, will be in a state of semi-turmoil or volatility for a longer period of time, until such time that there is stability which is seen in the Western in the Western zone. Okay, that's what I'd like to present to you all, and I would be happy to hear your counter view. If you don't agree with me, that would be nice, or if you have any questions which we could discuss. Thank you.
You know, Subramaniam ji, when he was a economic advisor, and the second day when he left the job, he said the government should transform the ecosystem if they want to achieve the $5 trillion economy. What's your thoughts on that?
So actually, I have a different view when you talk of a $5 trillion economy. Okay, so as economists, we all tend to be cynical. We tend to be pessimists. Okay, so just keep that in mind when you're hearing what I'm saying, because I believe that any economy will reach the 5 trillion mark at some point of time. And today we have this crazy situation where my GDP has grown because of high inflation. So if I'm going to get a 5 trillion economy because of high inflation, that's not going to serve any purpose. I think the critical point which we need to accept is not a 5 trillion. In fact, before a 5 trillion is spoken of, people are talking of a 10 trillion economy. Okay, so 5 trillion economy is something like saying that 375 lakh crores. And my current GDP is around 260 lakh crores. So 260 to 375, or maybe if I talk of 5 trillion at 80 rupees exchange rate, 400 lakh crores, it's going to take quite some time to get it. So what we need to actually achieve is a high real growth. High real growth comes when I create more jobs. And I think that's the basic thing which has to be done. And I think we all recognize the fact that jobs are created primarily in the manufacturing sector. And within the manufacturing sector, I think it's the SMEs. So I think the government needs to recognize the fact that today when we're talking of creating jobs, it's not by having a public advertisement saying that the central government, the railways, is going to hire 75,000 people. That's not the way it goes. Because if you look at the large companies, everybody hates labor. You want to lay off people, get in more technology. That's what the hard fact is. Forget about what we're hearing of companies like Byju's, the startups which are busy laying off people. If you want to create jobs, it has to happen only in manufacturing. So do we really have a structure where we can bring manufacturing back to occupying 25% of my GDP? We have not done it. I remember even in the past government when Montek Singh Ahluwalia spoke of that, we had this grand document which came making manufacturing reach 25% of GDP. We have been stuck at 14-15% because all the jobs are being created by these Swiggy guys are going, risking their lives, trying to deliver in 10 minutes, 15 minutes. That's not the way how an economy grows. So I think rather than looking at a 5 trillion economy, which will be achieved at some point of time, if not 3 years, it'll happen 4 years, if not 4 years, it'll happen 5 years. It becomes a kind of a rolling project. I will reach that number at some point of time. I think the concentration of the government should be on real job creation, not overstaffing. I think today what we're talking of, if suddenly one fine day the government says that I'm hiring 75,000 people, there is something wrong. It means what were we doing so long? Did the 75,000 number come up today? We know there are lots of vacancies which are there in the government offices. In fact, one interesting fact, I don't know, it was based on a PIB notification, a press release. For the civil services this year, I don't remember the exact numbers, they were supposed to hire around 750, 800 people. And finally, they only filled up around 500, 550 slots. 200 went begging, which means that there were 250 candidates were not suitable for these posts. So I think we have a fundamental problem out here. On one hand, we are saying that even on the public sector side, people are told that bring in more technology, reduce your staff. So the only people who can create it is the SME sector because the large companies don't want to hire more people. So I think that's what should be kept in mind, that if I'm looking at a 5 trillion economy, let's try and get an real economic GDP growth rate of around 8% per annum on a continuous basis, which can happen only when I'm going to create more jobs, because more jobs creates more income creates more consumption. And today the problem in India is that my consumption is not increasing. All of us are the well-off in society, we keep consuming goods and services, but I need to have the man on the street to be in a position to also consume. That's how we keep economies moving. And I think that's the same problem which even China has. The reason being that conditions have been abnormal. Maybe we have gotten out of COVID, but there are other kind of crises which have come through. And I think given the kind of contribution which the SMEs make, not just to employment, but also to exports, industrial production, overall GDP growth, I think this is a sector which has to be given further hand-holding in case they have to deliver a global, a national objective. So it's not to say that I want only SMEs to thrive, but it's a necessary condition if my growth has to actually reach this 7.5 to 8%. That's the way I look at it.
So thank you very much, Madan Saab. You've given an excellent overview of the economy. Just wanted one specific aspect, about this whole China and India aspect. Post-COVID, there is an increasing feeling that the manufacturing base, which was highly concentrated in China, most of the multinationals, they are thinking of clearly diversifying. And India being a very natural, next best destination, for them to come. And I believe certain, companies like Apple and certain other companies already announced, their plans. It is believed, and I'm coming from stock market, so I'm giving you some bit of, data on that. It is believed in the stock market that even 10% of this manufacturing base shifts to India, our Nifty will go from today's 17,000-18,000 to 30,000. And that's sort of a growth one can see. And stock markets being barometer of the economy, maybe a little bit of a time lag, but that's something that is what can be expected. And these are the next 10-15 years is that of India. My question to you is, number one, whether this kind of a shift you see it can happen, and if so, what is the role SMEs will get? What is the advantage or the opportunities SMEs will get to participate in this? Because any GDP growth, at least 30%, if not 40%, contributed by SMEs, the economy cannot see a massive, GDP growth. I mean, they play a very, very important role. And in that context, I'm saying that how SMEs will benefit from this shift, if at all that you agree.
See, what you're saying is right, but it's a big if, and we don't really know when it's going to take place. So quite clearly, if 10% shift is going to take place to India, there'll be a great benefit for Indian manufacturing sector. But so far, what we have seen is most of the foreign investment which comes in tends to get directed towards the services sector, especially finance, technology. The reason being that India is always considered to be a difficult place to do business. So notwithstanding the fact that there's lots of improvement which has happened, at least from the center side, but given the fact that we have a federal structure, we need to adhere to laws of the center, the states, the municipals. So even if you want to do something in Mumbai, for example, it's not just a case of saying that the center has made it easy for us. When we were talking of the World Bank doing business indicators, it was more of what the central government was doing. But then there are lots of clearances which you require from the state. You need to look at the quality of the infrastructure. Entering BKC itself is quite cumbersome. So we need kind of improvements to take place everywhere. So I'm not quite sure when this 10% number will take place, but let's assume that it's a worthy goal to have, that how do we actually migrate this kind of investment even in the non-services sector. Obviously the SMEs will have a major role to play out here because, and for this I think what the government has to do is create a PLI-like scheme exclusively for the SMEs. Because today, the way I look at the PLI scheme, it's a very good scheme, where it says it's performance-based. You perform, you do a certain amount of investment, bring about a certain amount of incremental output, and then I'm going to reward you by 4 to 6%. So this 2 lakh crores really has the potential of getting in something like 30 lakh crores of investment. That's a very good number. But if you look at most of the sectors, I think all the benefits are skewed more towards the larger companies. So we need to have something which is more fine-tuned towards the requirements of the SMEs. Because as we all agree out here, I think everybody admits that SMEs are actually, it's not just a case of giving credit. So far what I've seen is that most of the time we say that, okay, you have a problem of credit, I'll do a subvention, I'll give you a guarantee. But ultimately we have to make sure that growth takes place in the production side. So I think having a PLI scheme, PLI-like scheme exclusively for the SMEs is what we really require in order to bring about this transformation. It's going to be a slow process, but I think if such a thing is introduced now, over the next 5 to 10 years, we could really achieve something which is significant.
Sir, one important aspect, probably you missed it, is that real estate business in, especially the earlier tagline was, roti kapda makhan. But it has now reversed. Because Makan is the one, even the government of India has been promoting that, that low-cost housing, which, yeah, I'll come back. So the issue is that, the lower profit in consumption areas. Is there a link between these two things in your presentation?
The link between, sorry, I didn't get the question.
The lower profit in the even MNCs like Unilever and other aspects, and the bigger construction companies which are coming to India for increasing the delivery of houses, low cost houses.
No, I think we should separate the two issues. When we're talking in terms of overall performance of companies, this is a current phenomenon, not something which we would expect to last forever. So it's more of a 22, 23 kind of a phenomenon and a reflection of what's been happening at the global level. Now, when you're talking in terms of specifically the real estate sector, yes, the kind of benefits, the kind of thrust which is being given by the government, especially for affordable housing, and also the fact that the market has been fairly dormant in the last couple of years, I think there is definitely a lot of interest which is there. And I think with RERA also coming in, I think that has been a big benefit, or we're trying to formalize this entire process of real estate, because earlier it was considered to be primarily in the informal sector. But today, I think when we bring about this kind of formalization, I think there is a lot of potential for investor interest in this particular segment.
Thank you. When we are talking about made in India, since you said about employment generation, Mr. Sinkar and Mr. Shah is aware about particularly the level playing field in India. If we talk about make in India, currently we observe that around 3,219 foreign companies invested in India, and they are operating in India. Whether government has lack of knowledge to attract more companies in India, because China, the most global companies from China going out, why they are not attracted to India? Where we are lacking? What is your observation?
No, in fact, when we're looking in terms of foreign investment coming into India, I think it's a case of what kind of a business environment, the business climate which is provided by the government. And I think the role of the government actually ends up there. And it's left to the industry associations as to how do you go out and you actually speak about Make in India. How do you go around and propagate the fact? It's a case of selling the country, saying that, look, why don't you come and invest in India? So to my mind, I think the government is more of an enabler. So in terms of the reforms, the kind of structures which you keep in place. And I think here, one can always say the government has scored 100 out of 100. Okay. But as I mentioned, we are in a federal kind of a setup. What happens in Mumbai doesn't happen in Gujarat, or what happens in Gujarat doesn't happen in Rajasthan, or what happens in Tamil Nadu cannot be replicated in other states. So I think it's a case of saying that all the state governments as well as the center will have to put up a combined front to say that you come and invest in India. And I think the onus also falls on industry. When I say industry, I'm talking of basically all the industry associations, that individual companies cannot go. And I think a lot of this keeps going on throughout the year. So when you have these delegations going and trying to attract investors to say that, look, why don't you come and invest in India? And because the opportunity is always there, given the fact that we have a population of 1.4 billion people, it's a huge market. Okay, we have seen that while we can get into a debate about whether people are more poor or less poor, but definitely I think the quality of living, the income levels of people have definitely gone up, and the aspiration class has actually increased, which means there's a huge market which is there. Even a poor person today would like to have a mobile phone of the latest make. So therefore, there is a lot of opportunity, and given this plethora of opportunity which is there, everybody is interested in India. And the other thing is that we have a lacunae. When I say a lacunae, because we have very poor infrastructure even today, it also means that there is opportunity for investment to come. Now, how do you make sure that this investment comes? This is through an enabling environment, and make sure that it becomes easy, and we should not get a bit hyper about saying that, I think Make in India is a good slogan to have, but we also need to know that we need to accept that we need foreigners to also come here and get in, because this kind of money which comes in is actually investment funds which are here to stay forever, and they can contribute a lot, given the fact that today if I'm looking at growing at 8% per annum in future, I'll have a funding problem in India because our savings level is very low. So we do need to have foreign funds, and foreign direct investment which comes in can provide a major source of funding for this entire dream which we're talking.
So thank you very much, Madanji. This topic, India economics preparation to face global recession. This topic I'm going to continue because we have to create awareness amongst our industry, particularly how the Meta and Twitter is struggling nowadays. Rather, I was thinking yesterday, if Twitter and Facebook will close down, what will be happen about our politicians? Because morning to evening they are giving the best wishes to each other for a birthday and all these things, but they are not focusing the issues and problem of the Ashok bhai hamare industry ke. So if the Meta will be closed down, I'll be very happy. So at least a politician will come on the platform. So thank you very much. Thank you, Madanji. Let us continue our this topic so that we can create some document for the government and particularly financial institution. Thank you.
Thank you, sir. With this, we move ahead with our next speaker, Mr. Dhaval Vikamse, Head Client Acquisition, UB, and his topic is Transforming India, Leveraging Technology to Fund Enterprise Growth. Welcome, sir.
So, we represent UB, which was erstwhile known as Kadami, if you all recognize that brand. We repositioned our brand name a couple of months ago. We have started with the idea of deepening debt markets in India. Right? If you look at developed economies abroad, typically most of the money is in the debt markets is evenly distributed across large companies, smaller businesses, MSMEs, SMEs, or equivalents thereof. However, in India, that's not necessarily true. If you see most of the money, and even Madanji highlighted how the PLI scheme was largely geared towards the larger corporates, right? If you dissect the entire wholesale lending business in India, majority of the money is given to AAA, if I use ratings as a proxy, AAA, AA rated space, right? That entire group of companies would be approximately 1,000 to 1,500 companies only. The total debt market in India and wholesale lending from formal banking channel stands at approximately 3 lakh companies which have access to debt in the formal banking channel. Majority of the money is going to the top 1,000 or 1,500, right? So we started UB around October 2020 with the idea of deepening debt markets in India. There are challenges that we have realized as a business that are there in raising debt for businesses in India. And that's where the genesis of UB came around. So just a little bit of corporate history. We're a Chennai-based organization with offices across India in Bombay, Delhi, and Bangalore, and soon to open in Hyderabad and Chennai as well. The company was founded by Gaurav Kumar, who used to be the chief business officer of another NBFC in Chennai called Northern Arc, or IFMR, if you all have heard of that name. Till date, we've raised as an organization approximately $237 million, and we turned unicorn around in February earlier this year. Now, as a business, we are structured as a marketplace, a two-sided marketplace. Closest proxy, if I would urge you all to think, is that of a Flipkart or an Amazon, wherein you have buyers and sellers on one side of their platform. Buyers are people like us, and sellers are businesses. Same way, our platform is structured as a marketplace. So we run a website called goub.com, wherein we have businesses on one side of our platform, which are a mix of corporates, NBFCs, startups, fintechs, MSMEs, SMEs. And on the other side, you have lenders, which are typically banks, public sector banks, private sector banks, foreign banks, NBFCs, larger NBFCs, AIFs, international and domestic credit funds, as well as offshore funds as well, right? Till date, as a platform, we have enabled organizations access credit or debt to the tune of about 1 lakh crores in a span of approximately 2 years now of our journey. And we've done this through 3 key products which are geared towards SMEs, MSMEs, and mid corporates or emerging corporates. Right? So these are across products, across loans, capital market instruments such as bonds, as well as supply chain finance. Right? As a platform, we essentially offer discovery in terms of discovery of businesses' debt needs in the lending ecosystem across lenders, as well as delivering on that transaction or deal requirement in terms of negotiating, executing, structuring the entire transaction. And then thereafter, there is a post-transaction fulfillment, which happens in terms of meeting lender compliances, releasing quarterly information or half-yearly information. Today on our platform, we have close to about 3,000 odd borrowers, and lenders are across about 750 plus lenders today using our platform actively. Now, the genesis of why this exists in the first place is, like I mentioned, to deepen debt markets in India. But the challenges that we see businesses face in raising debt today is that in certain parts of the country, not Bombay, but certain parts of the country, there is limited access to lenders, right? Because of location-specific issues. Every lender is not there in every location in the country. Because the business of raising debt in India is tedious, credit evaluation takes time, understanding different lenders' processes takes time. The overall timeline for organizations to raise money leads to higher turnaround time, right? So it takes quite a lot of time to get any sort of sanction as well as disbursement for your business needs, right? Apart from that, even once the money has been disbursed for any borrower, there are tedious lender compliances which need to be followed in terms of quarterly updates and stock statements and things like that. Since every lending institution has its own methodology of evaluating a business, while there are similarities which are there, but there are challenges which come around in terms of policies and procedures, which leads to sometimes lacks of transparency in terms of raising debt for any business. So our view is that technology can kind of help you solve for these issues. How does that work? You can raise money through a paperless process. Credit evaluation can be less cumbersome for any business when it comes to raising money. By digitizing the entire credit evaluation process and breaking down information asymmetries which exist for you between lenders evaluating your business and your own information. Through technology, you can reach out to multiple lenders or lending institutions at a click of a button repeatedly. You don't need to necessarily go manually through this entire process, right? And technology also will solve as time goes by and businesses become more technologically evolved. You would see opportunities wherein systems would then replace human intervention and recommend the best product suited for your own business needs. That's a bunch of things that we've tried to do at UB. How does this really help businesses? It will help in reduction in turnaround time of raising debt, as well as reducing the cost of debt over a period of time. Right? Now, on our platform, we have different products that you can use our platform for raising money. There are different end uses for which you can use it. Can be used for raising money from a capital expenditure standpoint for setting up a new factory, doing a project finance, meeting your working capital requirements, as well as anything which is non-bank end use financing. Right? Banks will have an end use restriction which is there. You can use our platform for bank debt as well as non-bank end use debt as well, and also other products such as import and export related financing which is there. You can do that through a mix of end users is one thing, but the products that you can use it is for you can use debt products such as loans, bonds, as well as non-fund based facilities which may be useful for infrastructure companies as well as exporting and importing when you have LCs and BGs required. Today on just these products, our platform has done approximately 15,000 crores worth of debt in a span of 2 years alone, right? Now, these are all on-balance sheet solutions that our platform has to offer. There are off-balance sheet solutions as well as supply chain finance solutions as well, which Surajit from our team would kind of elaborate more. He's the expert there. You can use our platform for raising vendor finance as well as dealer and distributor finance, factoring, which is a product which is not very well discovered in India. There are barely any players which do that, as well as sales bill discounting and purchase bill discounting. The first three are off-balance sheet in nature, and the last two are on balance sheet in nature. Today on our platform, we have almost 10,000 invoices which have been discounted so far, and throughput every month is approximately 200 crores in terms of just supply chain finance that runs through our platform. Right? Now, if you are on UB, what do you get? What's the value prop for any business today? Right? You get access to lenders in a span of 30 minutes. You have a dedicated relationship manager from UB. The business of raising debt cannot be, you can't just take away people. Borrowers prefer somebody to speak with. So we have a dedicated relationship manager who is from the lending ecosystem and has been there, done that for 10 to 15 years, right? You start your lender engagement within a span of 2 days flat. The platform also aids in credit evaluation and reducing the process, reducing the burden of credit evaluation by digitizing a lot of information which is required by lenders to kind of evaluate your business. Through this mechanism, what transpires for you is a quicker disbursement and a fast and a far better competitive pricing which the market has to offer today, simply because you're reaching out to a lot of lenders which are recommended by our system. What we have done on our side is that we've digitized a lot of the lenders' preferences across banks. There is a recommendation system which sits in between, which identifies your credit profile, your business requirement, and matches that with the best set of lenders, which can solve for your debt need, right, or your business's debt need. And that way, you are able to access competitive pricing as well as a faster disbursement time, because you're not going after the wrong set of lenders for your debt ask. Let me take two case studies to kind of explain to you how that has functioned for a few organizations in the past. This is for a company called Gold Plus Glass. This is a glass manufacturer, and they were looking to kind of set up some production lines for their business. When they came onto our platform, in a span of approximately 2 months, they were able to kind of garner approximately 8 term sheets from different lenders to the tune of about 1,000 crores. They didn't need 1,000, but they were able to generate so much interest. Approximately 17 odd lenders were interested in working with this organization. But in the end, they closed about 430 crores in a span of 2 months, and with an interest reduction of approximately 3.5% for their business. Right. This company is a BBB plus rated company, so it is in the mid corporate segment. It is not necessarily it's not in the AA or the A space, which I was speaking about earlier, and has 1,000 plus customers, is 30 years old, is a hardcore manufacturing business. Right. Another case study to look at is in terms of supply chain finance solutions. There's a company called Zetwork, which is in the business of connecting B2B customers for job work purposes, wherein B2B customers need, or large corporates need manufacturing, capital goods essentially. They connect them to that and kind of help out in the entire manufacturing process. Now, this is a global company, right? They have suppliers which are across the world, right? And now this organization actually wanted to scale up their entire global network of manufacturers, and they needed capital for that. But obviously, cost of capital is expensive in terms of equity. So what do? You replace that with a little bit of debt. In this case, what happened was, on our platform, they were essentially able to generate approximately 200 crores worth of vendor finance program, create a vendor finance program for 200 crores, wherein their suppliers were getting easy access to credit through the UB platform, right? And this essentially worked with a very reduced stat, with pretty much in a span of approximately 45 days, when the entire vendor finance program took off, right? That's a very quick overview about who we are and what we do. We would then, showing you in case of some of the couple of borrowers which have used our platform in terms of the different types of debt that has been raised. It is across different ticket sizes, across different business segments and industries. I would now invite Surajit from our team. He's the Chief Business Officer for the entire supply chain finance business at UB, to kind of speak about our supply chain finance offering as well.
Thank you. So first of all, it's a privilege to have all of you here. I really enjoyed what the first two sessions Madan said, right? And before I get into my presentation, I think one of the points that I want to just carry forward from what you said, right? In a lot of ways, a country, right, is a country of conflicting data points. Right? If you look at, I keep saying this, that this is a BBB minus country where most of the credit is concentrated in the AAA and the AA segments, right? Also, a very pertinent data point is that while we speak about these 8 million odd MSMEs in the country, right? It's a pyramid with a very wide base, right? When we talk about the bottommost layer, right? That is in millions, right? Almost 7.5 million is in the bottommost layer. And then when you keep going up the pyramid, right? You're talking not in terms of millions, but in terms of lakhs, and then in terms of thousands, right? So why does this happen, right? And when we're looking at which product should we speak about in detail, and why did we choose supply chain today? In our opinion, it is not a lack of ambition, right? Which is resulting in this very wide-based pyramid, right? It is possibly the lack of capital, right, which is preventing this growth, right? Why are the constituents in the micro segment not graduating, right? It is, and subsequently from the small to medium, right? Why is that graduation not happening? So to a large extent, this is because capital is not available in the form of venture. Not every organization is going to, not every entity is going to get venture. So the next best is debt, and debt itself is also not easily accessible. But one thing which is there with you is your balance sheet, is your working capital. That is what supply chain can kind of unlock. So this product, the supply chain finance product, is a very, very versatile product. It is possibly one of the most versatile finance solutions that you can get access to. While the typical balance sheet products like a loan, a secured loan is something which is very well understood. What has happened over the last 4-5 years in the country is that the basic plumbing to replace physical collateral with digital and data as collateral has been laid out in the country, right? And using that, right, a lot of solution innovation is happening, and you'll see a majority of the innovation, if you leave aside the retail innovations, right, in the enterprise segment, it is in the space of working capital solutions, right? And that is why I keep saying that this is possibly one of the greatest value unlockers that you can get, right? It can benefit both your top line and your bottom line. For an MSME, if you're looking at growth, this solution helps unlock, unlock sales, right? Improve sales, improves cash flows, solves for both receivables and payables, and it also increases your balance sheet capacity. Very quick overview. Again, like all other UB products, our supply chain product also operates on a marketplace construct. So any efficient supply chain, if you see, right, it will require high velocity movement of goods in one direction and high velocity movement of capital in the other direction. So this is not a one-term product. This is a constant high transaction velocity product, right? So our overall marketplace today, we have about 50 plus supply chains that we have financed. What we offer is through the marketplace construct, over 20 plus investors who actively invest in various supply chains, right from a AAA rated entity supply chain to an unrated entity supply chain, right? And it is not just the discovery part, but it is the entire transaction processing part, because working capital is something that you deal with every day, right? So this is a very high velocity transaction tech driven platform that we bring onto the table. Why us? What do we really bring onto the table? What we have seen is that in a one-on-one singular conversation with a lender, right? You are able to get a solution for possibly 10 to 15% of your supply chain. And this primarily happens because your supply chains are not homogeneous, right? Your supply chain requires capital to be aligned at different risk points, right? And that is what a marketplace essentially brings onto the table, where because of the variety and the diversity of the lenders that we have on our platform, we are able to align capital at every risk point in your supply chain. The other piece what I believe is the key winning point, right, is that your supply chain is not static. There's huge transaction throughput, and this requires a technology-enabled solution. It is just not possible to execute without technology. So our platform delivers an end-to-end digital journey. If you have an ERP system, it essentially integrates with the ERP. It does the entire automated invoice processing, and then gives you complete insight through a very advanced reporting and business analytics module. On the transaction side, you essentially deliver a very digital experience to your vendors and dealers, and the platform also offers a digital experience to all the lender partners on our platform. So we primarily deal with two products. One is on the payable side, which is a vendor finance product, and then on your receivable side, which is a dealer finance product. We also have other flavors like a sales bill discounting and a purchase bill discounting. But I want to spend some time today on the vendor finance and dealer finance products, because one of the points that I made was, how do you expand your balance sheet capacity, right? So our vendor finance and dealer finance products are completely off balance sheet products, which means that they are not leveraging you at all, right? And it essentially increases your throughput in the business, overall business, right? You are no longer constrained for growth because of lack of working capital. This becomes very important also considering the working capital guidelines that the RBI had issued, right, which requires about 40% to come in as a loan and not as a CC. So a delivered solution gives a lot of benefits in terms of how you can manage your working capital. So if you look at your payable side, right, today there are two, three things that you essentially need when you are looking at really growing fast, right? You need to have strategic suppliers, high quality strategic suppliers. So how do you attract them, right? Payment terms is one way that you attract them. You are often looking at a DPO extension. If you want to extend your payables, deleveraging, and also because of the versatility of the solution, right? You can also use this as a margin expansion product, right? And we'll quickly spend some time on some of these value adds. So from a strategic sourcing perspective, if you are looking at attracting high quality suppliers, right? Payment terms becomes very important, and because most of these suppliers prefer to work with entities who are able to give early payments, right? That's a big problem in the SME segment, right? So what UBFlow brings onto the table is that we give you a completely off-balance sheet solution where one or more of the lender partners on our platform pay your vendors on day one, and then you can use that credit, and in that process, you are not the end borrower, your suppliers become the end borrower, right? So it is not on your balance sheet, and you can make the payment on behalf, post say 90 days or 120 days or whatever is the DPO target that you have, right? So this is a simple solution which kind of delevers your balance sheet and gives you the extension in terms of managing your working capital cycles, right? Obviously, what were you using till now on this, right? Typically, you're using levered products like, say, your working capital limits, right? So this is how you increase your balance sheet capacity by stop. Now, if you stop using your working capital limits and come to an off-balance sheet solution. We spoke about the versatility of the solution. So if you have cash surplus, right, what you can also do is that your suppliers need early payments, and you can negotiate early payment discount from your suppliers, right? For day one payment that a bank is financing, you can negotiate a cash discount, and it's a very simple arbitrage game where a bank possibly lends at say about 12%, you negotiate a 2% monthly discount, which it turns out to be a 24% discount, and that is the arbitrage that you create in terms of expanding your margins, right? So that's a versatility of the solution. You are either using it to deleverage or you're using it to expand your margins or treasury returns. Similarly, on the payable side, right, I think so there's the biggest challenge when you're in this 100-150 crore bracket is channel share, right? How do you win on distribution? And a lot of constraints in terms of winning on distribution comes from the ability to offer credit to your channel, right? Your distributors, right? So if you distributors essentially keep demanding credit, if you are a big large brand, right, the brand sells on its own, so that is what distributors pick, or distributors will pick goods where they have credit, right? Now, in the absence of any bank credit, again, you are using your own balance sheet, your own working capital lines to extend the credit period to your distributors. That's number one. The second piece is that the credit risk is now on your balance sheet, right? So our dealer finance solution essentially addresses that, where we bring in lenders, right, to finance your distribution channels, and they can pick up goods from you with credit, right, and then they become the end borrowers, and that is the entire setup that we create to ensure that you are able to win over on the channel side as well. So these are typically the solutions that we bring in. Very simple strategies to increase sales, entirely technology driven, and most of our solutions, whatever the way we have built out our solutions is that it rides on the GST network to use the digital collateral which is there. The entire trail in terms of your payments and your sales, right? That is what is used for underwriting, rather than the cumbersome process of a lot of documentation, right? This is that element that technology is giving for a very high velocity product for your business, right? Primarily on the dealer finance side, you will see most of the distribution channels have they're not homogeneous, right? And you'll have a long tail as well. So essentially what it means is that you need the diversity of capital in your entire supply chain. And through the marketplace approach, we are able to give you one consistent experience, even though you're transacting with multiple lenders across your supply chain. This is just an illustration of how we do some structuring using technology. We've picked up our distribution example here. So typically, if you want to eliminate this credit risk from a balance sheet, what you can do is you can offer a day one payment solution to your dealers or distributors. In return for, and what you can offer to get the dealers or distributors to pay you on day one and pay, basically a cash and carry model, is you can offer a discount. This is you can possibly offer a 2-3% discount to the dealer, right? To opt for a cash and carry model, and then the dealer, essentially we enable access to the dealer from we enable bank or NBFC credit for the dealer, right? And the arbitrage there is basically the discount that you offer to your dealership versus what the interest rate that the bank gets. So in return for this, right, in return for the discount that you are enabling for your dealer network, what you are essentially doing is that you are offloading the entire credit risk from your books. That's number one. And the second piece is that you are enabling greater channel share, because now you are no longer constrained by the amount of credit that your balance sheet can support. That's what I wanted to cover. I'll quickly give you a sense of how it works on our platform. It's a very simple digital journey. You just come up, register, you create a program. Basically, when I say create a program, it means you basically set up a vendor finance program or a dealer finance program. You give some basic details, and the key thing there is your entire GST verification, because most of our products, right, rely on this to give you access to this the entire lender ecosystem. Once your profile is created, we essentially unlock marketplace efficiencies where various lenders start looking at the opportunity, understand the opportunity by using the various credit tools that we have on our platform, and then the lenders essentially start buying for your business. You can look at the various offers that are there on the table. It's a fairly competitive, efficient marketplace hypothesis based on which the product is created. The key point here is that you are always in the market, which means that you are going to be rewarded for good performance, right? Each part of your supply chain, right, as and when you keep transacting, because supply chain is a continuous transaction product, as and when your repayments come in, right, your data gets much more enriched, and your entire borrowing rates, right, keep going down because of this performance on the platform. That's what I wanted to cover. Thank you so much for participating and giving us the time to present what we have. Right? Thank you.
Let's start with the panel discussion, and the topic for the discussion is riding the tech wave, why business and lenders need to embrace a digital future. The discussion will be moderated by Mr. Surjit Das, Chief Business Officer, UBFlow. Sir, I request you to please come forward. Now I would request the panelist on dais for the panel discussion, Mr. Amol Chaudhary, Director, KPMG Digital, Mr. Vikram Kulkarni, Director, Deloitte India, Mr. Alok Kedia, Country Head Corporate and SME, IndusInd Bank. Now I would like to request Mr. Surjit Das, Chief Business Officer, UBFlow, to give the token of appreciation to the panelists. Mr. Vikram Kulkarni, Director, Deloitte India. A big round of applause. Thank you. Mr. Alok Kedia, Country Head Corporate and SME, IndusInd Bank. Thank you, everyone. Now let us start with the panel discussion, which will be moderated by Mr. Surjit Das.
Thank you, gentlemen, for joining me. I think since morning we have heard quite a bit about the challenges that the MSME sector has been facing. We've also gone through what UB does, right? So I'm going to try and tie everything together in this panel discussion for the audience. Right? But first, let's start possibly with the representation from the lender ecosystem, right? And trying to just scope the problem. We spoke about this challenge of under-penetration of credit. I just wanted to get your thoughts that why is it that a segment which contributes almost 30% to the GDP does not get enough credit today?
Thank you. Let me start with thank you to Mr. Salunke and FP Chamber for having me over here. To answer your question, Surjit, see, first and foremost, of course, is the so there are many issues. One, of course, is the lack of reach. I mean, banks obviously cannot reach out to the, let's say, far off locations wherein the SME ecosystem actually exists across this thing. Whereas if you see the larger corporates, typically, as you mentioned, AAA and AA's are mostly located in the top 10 cities of the country. So reach is one of the reason. Second is, of course, it's not about our bank or let's say the biggest reason I would say is a lack of data. Lack of reach is of course there, but the biggest reason is so we are willing to lend. See, reach can be probably with technological advancement. The world has become smaller. So probably this geographical reach can be probably resolved. But the lack of the data is the main problem that banks face. We don't have any data as to on the basis of which we can finance many of the SMEs. Okay. So digital, I mean, collateral, as you mentioned, digital collateral is what we actually require, and GST data, which has now, let's say, started coming in, is actually proving to be a big tool for us to actually start financing more and more SMEs. So as we start, I mean, as the country gets more and more digitized, the data gets more and more digitized. The availability of the data becomes easier. The accessibility of the data becomes much more stronger. You'll see, I mean, banks and other lending institutions start lending more and more to the SMEs.
Thank you so much, Alok. I think on a related note, Amol, if I can get you into the conversation, right? So how do you, based from your vantage point, right? How do you see the digital landscape, digital lending landscape, right, evolve over the next 3 to 5 years in the country?
Can I borrow this? Yeah, thanks. First of all, sorry and apologies for this fiasco, but no matter how tempted I am to accept it, but I can't do it. Now, coming back to, continuing the conversation which Alok picked up, I think what I see, physical and geographical distance is no more a factor at all. And considering how the businesses have shaped up, and how the events have unfolded in the last 2 years, 2.5, 3 years, due to this pandemic, I think smallest of businesses have made sure and realized that they have to operate it in a digital way, irrespective of sector or the product line they are operating in, whatever business they are in. What is preventing, and what is the challenge that they are facing? So definitely lack of data. The reason being, you have two spectrums. When you see the credit outflow, which is like the business credit is around 80% of the total credit, right? The way it is concentrated, you already touched that upon during your conversation. So I would not go into the detail. So business credit process is still highly manually intensive process in any financial institution you go. Though we talk about making it as digital as possible, but there is a lot of manual intervention and subjectivity goes into it. It cannot be 100% digital or automated when you compare it with a retail lending kind of process. There the problem lies when you are evaluating a large corporate or large company. The subjectivity that is brought into during that evaluation, the parameters are very different, even though a lot of concentration is there and a lot of defaults are there. But the subjectivity and the evaluation to which the SMEs and MSMEs are subjected to is very different. It's difficult. It's difficult for them to get that access to the credit. It's not lack of technology. It's not lack of reach geographically I think it is a lot of philosophical mindset, the way financial institutions do the business. Technology is there now, it is available to everybody at every, as per your appetite or whatever your affordability. That's not going to prevent you. Solutions are there. Only thing is, unless you change your business philosophy, that's on the lender side. Coming back to the borrower side, so there is a lot of symmetry and disparity. How mature they are. Earlier, the focus was, somehow I have to drive my business. Because when you look at this, what is the difference between a PE fund and a bank? When they do, lend to someone, PE funds, banks lend or financial institutions do lending based on outcome-based parameters. They see what is this business generating, what is worth, as opposed to a PE, which will look at a promise in that idea that they are investing in. Maybe financial institutions have to revisit their philosophy, look at it as an investor, as a partner, like the PE funds do. I think that is where the mindset and change is required. Technology is there. It's not difficult to find, believe me. I've worked in developed market, developing markets which are way behind as compared to maturity you see in India. So technology is not a problem. That's what I feel.
What Amol has said. I agree with you that the mindset was also an issue earlier on, more so earlier on, but it is changing. It's changing, and see why this mindset was there, because of genuine reasons. Because the data was not there. I mean, and for this even SMEs were to be blamed to a large extent, because they were not showing their true financials in their balance sheets and their profit and loss account. So there was no way actually. I mean, ultimately, it's public money that all the let's say NBFCs or banks deal in. So they can't be actually frivolous about it. Okay, so they have to take something into consideration before deciding to lend or not. So now that actually the data is getting available, so they are changing their mindset. And if you ask me, huge amount of mindset change is indeed taking place in the banking segment. And I can tell you, everybody is actually running after the MSMEs and SMEs. And data is where actually, which is helping them out.
Thank you so much, Alok and Amol. But I think you raised a very pertinent point, right? That responsibility is not always the lenders. And as we move to a more digital currency, right? And I want to go to Vikram on this question, that as we go to a more digital currency, right? What is the role that technology can play in helping SMEs maintain their, help them maintain the purity of the data, right? In terms of, say, the meeting statutory GST compliances, because in the future, if a lot of underwriting, especially in short-term paper, is going to happen on this data, right? They have to ensure that this data is pristine. Right? So what role can technology play there?
Hi, thank you. Good afternoon all. This is a very interesting question. First, a little bit background about me. So I am a subject matter expert in the indirect taxes, that is GST and customs. We have heard a lot being mentioned about the GST ecosystem. In the sense, the NBFCs or these lending platforms are relying, or maybe going to rely on the GST data, which you just mentioned. The data, how it is important is that probably GST data would play a major role. In fact, there is going to be a provision which already is in the GST Act, and that is to give ratings to the businesses basis their compliances. So if you are compliant in your GST compliances, payment of taxes, filing of returns, you will be at a better pedestal or a higher pedestal to obtain maybe finance. Now here the question comes as how to maintain that balance. Now what I understand, particularly with the SME sector, is that they face a lot of challenges in terms of compliances. One is, of course, since GST is completely digital, there is no question about they not being technology not being a part of their development. It is already there. The question is, like, very simple example is that when you issue an invoice in a particular month, you are required to pay the tax immediately the next month. Whereas your payment comes back to you maybe after 3 months, 4 months, whatever. So here the question of working capital blockage comes in, right? I mean, SME does not, I mean, they are anyway very hard pressed for, money. Now, if they default, I mean, what happens is either they pay up, or if they don't pay up, they default. So effectively what happens is their rating may go down. They become non-compliant under the GST ecosystem. So that is where probably, entities like you all can come into play, and maybe, as something which is similar to your discounting pattern, maybe you can provide finance at least to take care of that tax compliance part of it. So if a GST is payable, and if you are, if somebody doesn't want to, take that much, finance to, discount the entire invoice, maybe you can provide them finance to take care of whatever cash component of GST they're going to pay up. So that way they will, have that comfort that at least they are not defaulting. They have the capital at a very nominal rate, and wherein everybody wins in the bargain.
Thank you. Just continuing on this theme of moving to a more faster access to capital using digital lending, right? Amol, I just want to hear from you, right? There is also a challenge when you start using surrogate data, especially if you look at the SMA pyramid, right? Where at the bottom of the pyramid, I think in the sole prop ecosystem, the personal data kind of merges with business data, right? So what are your thoughts on how the regulatory system is involved to take care of, say, data privacy concerns, right? So if you can just throw some light on that.
See, regulator have one simple objective. They have to protect the depositors. Okay, that's their money. As long as lenders or any financial institution is able to convince them that I am taking care of the risk, right? This is what happened during the capital adequacy guidelines when they came into picture, right? Basel II and henceforth, where regulators were willing to give that freedom to banks to build their own credit models, right? Earlier used to be the standard approaches and all that, yeah, to an extent, so that you don't have to put all those reserves lying idle, not using it for business. As long as you are, because I have worked with RBI for 3 years with 2 governors, and I have seen they are open to suggestions and recommendation. You have to go and tell them that, but I'm taking care of the risk. These are the measures I'm implementing. Coming back to the data part, so you hear these lot of new tech concepts like AI, ML. These are like 80s neural network models which are always there. We studied those. Only thing which was not there was the capacity to process it, right? which now is available, because you can have technology solutions. You can enhance your capacities within a, overnight, right? So you have these multiple sources of data which was not available earlier. I completely agree. While you are underwriting a loan for a business where there is no data available, due to this digital push, GST being one of them, it has made it mandatory for businesses to have that data available and transparent. They can't do much about it. So now it is there. Now there are a lot of other factors as well, which you can use to predict a lot of events. Whether it is available in the on the social platforms, you can go to the extent of each individual promoter level data and see every action, how is it going to impact the business and eventually my interest in that business. So that is the extent to which the financial institution have access to the data now. They have the platform. Only thing is they need to bring those models to the more mature level. Regulators are willing to do that. If you are using a particular algorithm, these multiple sources of data, you are able to demonstrate it to them that I am taking interest of the risk. I am not just ignoring things, and also I am not also a kind of being unfair to a borrower. So I think and technology is not one way is the only way of doing it, because the transformation is going on both the sides, lender side as well as the borrower side. So you have that synchronization happening very well. which is, I think, evolving in India, like the platforms you discussed. Right, 3 years back, availability of these platforms, for example, invoice financing and all that, was not that easy. Now you can hook onto that very easily, get access to multiple sources of this credit. Anyways, you are doing a lot of processing, which is helping a financial institution to make those decisions, quick decisions, and extend that credit to those participants on the platform. So from regulatory perspective, it's very simple. As long as you are taking care of the risk, you are convincing them that you have built proper measures to take care of it, I think they are open to listen to you and consider your recommendations, suggestions, or your grievances.
Thank you so much. Alok, from you mentioned that lenders have started, banks and NBFCs have started using a lot of this digital data now, right? So from your perspective, how are you seeing the evolution of credit products? What credit products are evolving faster than others, right? In terms of which are designed for the SME, right? So where are you seeing the maximum intervention of technology?
So the maximum this thing that I'm saying is supply chain finance, as you gave a detailed presentation about, and I particularly see supply chain finance as the biggest tool for financing the SMEs, because obviously it does not involve any kind of collaterals. It's based all about on digital collaterals only. But here the biggest stumbling block is the lack of awareness about supply chain finance, both on the anchor corporate side as well as on the SME side. And that is where actually platforms like you are doing a very great job of creating that kind of awareness. I remember, I started handling supply chain finance almost like 17 years back. Okay, and at that point in time, probably 4 or 5 banks used to do supply chain finance bank. Today, probably 10 or 11 banks are doing. So even on the bank side, there's a lot of lack of awareness about the supply chain finance, but gradually it is increasing. So supply chain finance is the biggest area where I see a lot of inclination of the banks and other lending institutions to do funding to the SMEs.
Okay, thank you so much, Alok. I think completely resonate with that. That is one area where I think maximum value unlocking can also be done, right, for the SME. Vikram, I just want to end with with one question to you, right? So, from are there avenues where say by easy credit availability, the SME can also take advantage of, say, indirect taxes, exemptions, trade facilitation measures?
Yeah, it's a very, very pertinent point, Sujit. So apparently, we discussed earlier during the day about India becoming a 5 trillion economy and competing with the Chinas of the world. Apparently, yeah, the ecosystem is developing on that, and of course, the government is doing all out for the Make in India and Atmanirbhar Bharat kind of things. One thing which was mentioned was that mostly it is the foreign companies who are coming and taking advantage of those facilities, such as PLI scheme which was introduced. Now, apparently, the PLIs there was also a small section, portion amongst the PLI schemes earmarked for the SME sector. But I don't know whether there was lack of awareness or what, but then probably not everybody went in for it, or maybe even if people were aware, they could not go for it because it required a lot of tick box items, and the main amongst them was investment in a given particular period, 1 year, 2 years, and things like that, which is where probably this aspect can come into picture to, one, make an awareness, make these SMEs aware, and also to provide them the finance so that they can avail of these facilities. I don't know, many schemes are there floated by the government of India, particularly for export-oriented units from the custom side. For example, there is, you may be aware that we have got free trade agreements with various countries. For example, SAARC nations, ASEAN, Singapore. Recently, we had a free trade agreement with UAE. Now we are in talks with UK. Now, what it means? It means that there will be facilitation measures. We can import material at a lower rate of customs duty from these countries. Are we taking advantage of this? SMEs probably should be made aware. There should be education. They should be educated about these facilities being available. There is something called an inbound manufacturing facility under customs. Now, it means that you get your premises converted into bonded premises. You import without payment of duty. Okay, you manufacture in your premises and then clear it even 100% to the domestic market. Effectively, it means more working capital in your hand. So the problem is there are facilities, there are schemes by the government, but at times the SMEs, even if they are aware, either they are not aware, or even if they are aware, then they are probably held back because of the lack of capital, lack of funding. So maybe a digital platform and easy availability of credit on that front would not only be beneficial to the SMEs who probably hold the future of the of our economy, of generating the employment in our country, and I guess that's where we can play a big role into it. Thanks.
Thank you so much, Vikram. We will with that we'll end here. Thank you so much, gentlemen, for your views and entertaining the questions that I had.
I just want to basically make two urge. Most of the SMEs are most of the audience belongs to SME segment over here. I just want to make two suggestions to them. One, since I spoke about supply chain finance, see most of the SMEs are either supplying to large corporate or medium-sized corporate, or let's say buying from them, right? So supply chain finance basically works as a bridge between supplier and the SMEs and the large corporate. So if you, in case you're doing that, and yes, if you are not aware about the supply chain finance, do ask your anchor, whether you're supplying to them or buying from them, to ask for the supply chain finance so that they can actually go to their banks and try and arrange for a supply chain finance program for you, because it is very, very beneficial to you. It comes without collateral. Second, please do maintain, try and show whatever maximum you can show in your books only, because a lot of financing is going to happen based on what you show on your books. Otherwise, obviously, you get constrained for the financials. You asked about the thing. So banks have started taking a lot of comfort basis data, including your bank statements. Even if the GST data is not there, for example, I can take a lot of comfort from your bank statement. Of course, there are now technologies which can analyze your 100-page bank statement in a whisker, okay, and give me all the kinds of analysis based on which I can decide to give funding to you or not. So these are my suggestions to the SMEs.
Absolutely, Alok. I think the Lego blocks for using the digital infrastructure, coming in together, right? You have the GST network. You're also getting into the account aggregator network. It ties in the entire bank statement analysis with GST, right? I'm pretty sure that very soon, and there's already technology available on the ITR side as well, right? So very valid point. Amol, any points from you before we end?
I think just echoing back what Alok just said, it's very relevant. I think eventually it comes to the transparency and availability of data, which gives comfort to the lender. Similarly, when the investors look in, for investing into a business these days, PEs, they want to invest in a business which is very, very auditable, easy to audit, as transparent as possible. Eventually, that gives them a comfort that it's going to be run properly and in a fair way. I think that holds true for everything, and now we are getting used to operate in a digital environment. So eventually, when we say digital, all the data has to be in a digital form, which will make everything easier and transparent for everybody, every entire ecosystem partner, and lenders being one of the key ecosystem partners. So I think same thing. Look for automation opportunities, digitalization opportunities in every facet of your business. Yeah. So I think that's. Thanks.
The way digitization is happening across the country from the government side, ultimately, they are going to catch you. Be rest assured. So better to actually start.
That should not be the motivation.
That should not be the motivation.
Yeah. Just to add to that, in fact, he's very right. He bang on point, because nowadays we are seeing a lot of data collation, data comparison we are not aware from where they are getting the data. It's income tax, GST, your banking. They are now, the government is gathering data from everywhere. They are collating. There are systems, as you mentioned, AI. It's throwing out red flags, and you'll find, authorities stepping at your doorstep one fine day and asking for details, asking for questions. I'm sure many of you might have already received for the mismatches in your TDS returns vis-a-vis your GST returns and the things like that. So yeah, data sanctity is a must, and to maintain a balance and equality or uniformity across your filings is a must in case you want to grow. Thanks. Sorry.
I want to give a very interesting. It's an event which took place. So one of the businesses, small businesses, files their GST returns, and also they have claimed that they bought 11 desktops. Okay. Now the GST department has the measurement of your premises in which you are operating. And they picked up that case and they sent a simple query. You bought 11 desktops. Where did you put those? The place in which you are operating cannot accommodate 11 desktops. So this is the extent to which they have visibility. And this is a true event. Okay, because they were claiming some tax benefits or something. So that data is available to them. But that should not be your motivation. Believe me, it is fuel of the business. The more data you have, it's not only for the regulatory risk and compliance perspective, which will eventually help you understand your business. You know better than anybody sitting here. You have been running it for years. But that's a feed, that's an input to the future of your business. So I think, and repeating the same thing. Thanks.
Thank you so much for your point of views. Right, I think this was fairly highly engaging. Right? Once again, thank you for the participation.
Audience. Yes, specific question.
We are funded by the best banker in terms of working capital and all that. Everything in place. But even today, if I need a bank guarantee, it's digital, physical, WhatsApp and phone call. Everything I have to do to get one bank guarantee, it takes 7 days. Okay. Or even more sometimes. So can we have a sort of a platform where if I need a bank guarantee or a letter of credit, I put in something like a UB platform, and at least I am allowed to speak to 3 bankers to get my bank guarantee, a quote and a bank guarantee.
Very good suggestion. Rather, you should
take a banker, the best banker in India struggles to give bank guarantee.
24 hours में होना चाहिए.
12 hours sir, digital है. I have done all data entry. Banker का पूरा काम मैंने किया है.
See, many banks have these platforms, and wherein they are issuing within 24 hours. But at the same time, there are process issues at the bank's end also, and many times actually we don't get all the documents from the customer. That's the main reason of the delay. But we have platform wherewithal to issue LCs and BGs within 24 hours. That much I can say.
I have my team of people who are expert for last 10 years. They know what to put document where.
So which bank you are dealing with? Maybe you can.
I can know that is the number one bank in India. And private sector bank. I'm not.
This is the challenge with best of the MNC banks. Okay, so you name any bank that's there, LC, BGs. We ourselves face this problem.
Yeah.
Okay. But there is a transformation wave going on. So I'll tell you, corporate lending and this, corporate banking is a very, very big area for transformation. You see a lot of transformation happening on the retail side, download the app, this loan and that. But corporate side, because there's a huge amount of documentation involved, large amount of sums involved, right? So, but still the processes they have a lot of manual intervention which can be removed. And I think some banks are doing it. Maybe in a year or two, this transformation will be visible.
Vikramji, you can highlight on. See, usually GST, according to GST, most of the banks are looking for the credit worthiness of their company. Similarly, the bank guarantee or any other support required from the bank, or we want to avail any support services or any financial product. Can we have the system that in a PAN card, GST, looking at the banking accounts, can we do some model for that? Or can we suggest?
That can always be worked out. And in fact, as I mentioned earlier, even the GST law also provides for grading the assessees. So if basis their compliance, etc., and all other parameters. Because in any case, GST at the back end, they have an data analytics wing which is comparing everything, and basis that they'll be coming out with the gradings. Now, if you are graded at a higher scale, obviously anybody, be it your lender, be it your customer or a vendor, if they can definitely rely upon that grading, that you are virtually covered from all sides and you are a safe bet to go do business with. Yeah.
See, yeah, please go ahead.
So most of the banks have this something called scorecard. Okay, so scorecard has many parameters which go into it. Okay, the GST data is there, the financial data is there, the civil data is there. Okay, so based on all the data that get captured in that scorecard, a score is thrown by the software, basis which the banks decide how much to give and whether to give or not. So that and these models, they are various models under which these scorecards are made by the software companies only, and these are always under upgradation. I can tell you, a command department which is always upgrading and trying to upgrade the cases to make it more stronger. And
इसमें एक बात है आलोक जी, most of the banks what they do, you know, once they receive a proposal, they do the work on the proposal. They take a lot of efforts to review the proposal, take guidance from or suggestion from the experts, and ultimately before issuing the sanction letter, they go for a civil report. जैसे अभी कल इंडिया का देखिए कितनी अच्छी मैच खेलते रहे, लास्ट में हार गए, वैसा हम लोग हमारे एसएमईज हार जाते हैं.
Civil report is now part of that.
No, but credit worthiness to be checked at the time of entry. Because ultimately 1 month or 1.5 months हमारे एसएमई एंटरप्रेन्योर या कोई भी एंटरप्रेन्योर पोल एंड पोस्ट भाग के सब कुछ बना के दे देते, लास्ट मोमेंट में कहते हैं नो यू आर नॉट एलिजिबल फॉर दैट.
In many of the banks, up to 1 crore limit has become very seamless without any manual intervention. कुछ भी, suppose everything is decided by the software up to 1 crore. Of course, as we move along, higher amount will also get captured.
होना चाहिए, and all suggestion goes to UB because you are brought out some best platform. Rather, why don't you take more suggestions from the segment, banking perspective, entrepreneur's perspective, company perspective, and then you can modify and develop. See, usually currently no one is interested to go in a branch. The centralization is there, but sometimes we have to deal with the branch manager, then AGM, DGM, then DGM say, no, you have to meet our GM for final interview. So this should not be happen. So UB should come out with a lot of because UB flow is there, UB loan is there, UB co-lending is there, UB pool platform is there. So we have to take forward.
How does this issue can be resolved without any hindrance or pain points to both lender as well as the receivers? Is there any mechanism which, because there are three very important, Deloitte is there, Indus Bank is there, and you, KPMG is a very and for SME Chamber of Commerce is really doing very good work. For last 20 years we know Dr. Salunke is doing so many good things, bringing all the people together. But this is a real pain point. How do you?
I'm not a medical doctor. I'm a doctor for SMEs.
Thank you.
You can see the representation of the business community in the policy formation in this country, right? You must have noticed that. So similar initiatives are visible across all the touch points or components of this ecosystem. It's already happening. Multiple factors are contributing into it. One is this aspiration of becoming a 5 trillion economy, which leads into, or which requires as a prerequisite to make it as easy as possible to do business, because this is where the jobs are created from. Even the government sector, I consider them, most of them, as employment creation schemes. The money has to come from somewhere, which is this 25% of contribution from manufacturing, which is showing its ripple effect in everything in the credit institutions as well. Now, if you look at the banks, the way they used to operate 10 years back and the way they are operating now, be it lateral hiring at the topmost positions in the bank. Now you have banking CEOs, PSU banking CEOs, who are not from the government sector. They have been taken from private sector to revive some of the struggling banks. You have a couple of major banks that have done it, which is changing the entire way they have been doing business and which is reflecting. So it is, I think, because see, we as a society, as somebody mentioned, there are a lot of businesses which are not even involved in the credit ecosystem. But that doesn't mean they don't have access to the capital they have. There are other sources of capital. That's how we are socially structured. So I think that change is already happening. It has to reflect everywhere. I firmly believe that answer to many of our questions goes through the technology and data. So I think that is an enabler which is making it possible. Access, accumulation of data, processing of that data, and arriving at insights which can contribute into making fast and right decisions. So I think it is happening. There are a lot of things which have to come together to make it happen, not one institution. It is a policy level, it is the execution, implementation level, and eventually at the receiver's end as well. The business have to change and upgrade their way of doing business, right? So that they can impact and contribute in the change of this philosophy. So I think it is happening and everybody has to come together, influence. Now every individual can raise their voice because of these social platforms. So do the businesses, and which is happening. You must have seen a lot of incidents which have hit the topmost levels and got the attention from there. Some resolution have come. So I think this is, I'll say, it's a more of a kind of a social and political, issue to address than a technical or technological. That's what I think.
Let's discuss later on the political while having a lunch. But meanwhile, what the UB has transformed, a technological platform. Let us see that.
Meet Mohit from Future Motors, leaders in automobile manufacturing. 4 brand new cars roll out of Future's assembly line every minute, for which Mohit's role as procurement head is critical. Future has a massive supply chain network. Mohit and team have to ensure that the 1,000 plus components that go into Future's cars arrive on time, every time, from their extensive supplier network. Then there is Riaz, the sales head, whose sole focus is to ensure that Future's dealers are buying and selling more. On the other hand, Monica, Future's CFO, has the challenging task of managing working capital requirements of Future Motors and keeping debt levels under control. To optimize working capital, Monica expects a 60 to 120 days credit period from suppliers who need money on day one. Monica also expects that dealers pay upfront for delivery of Future's cars. This could potentially strain the relationship between Future and its suppliers and dealers. How can Future balance its own working capital needs with the needs of its suppliers and dealers so they work like a well-oiled network? Enter UB Flow, the most flexible and advanced supply chain finance platform for corporates covering various sectors across credit ratings. The platform's guiding principle is that supply chains are heterogeneous and therefore capital needs to be aligned at every risk and price point from multiple financial institutions. UB Flow's dedicated relationship manager helps onboard Future Motors on its platform in a simple and efficient manner. Subsequently, Future creates a vendor finance and dealer finance program on the platform, specifying a few parameters. Now UB Flow's AI matchmaking engine gets to work. It ensures that Future's supply chain finance program is visible to the right financial institutions from among its vast pool. Mohit and Monica are spared the effort of chasing multiple financial institutions to find the right partners. They receive competitive proposals with desired terms. They soon find the right partners in Glowbank and others. Future's program now goes live. In just a few days, bulk of Future's suppliers and dealers are on board. Suppliers start uploading invoices on the platform, which are automatically processed and in less than 24 hours, they receive their due payments. On the other hand, dealers start placing more orders with Future and Future gets its sales proceeds on day one. Future Motors, their suppliers and dealers are delighted as all of them get an injection of working capital in no time and without any hassles. The UbiFlows platform's automated invoice processing and customized dashboard with critical data points help Mohit, Riaz and Monica strengthen their relationship with suppliers and dealers while freeing up their time to focus on other important matters. Since Future is able to negotiate better interest rates, they pass on some of its benefits to their partners. With UbiFlows supply chain finance solution, Future Motors not only solves its working capital requirements but also gets many other benefits. It ends up deleveraging its balance sheet, extending days payable outstanding, reducing days sales outstanding, improving its rating, improving its profit margins, increasing sales, and attracting the best suppliers and dealers. UbiFlow, cash flow optimized.
Thank you very much. So it's my special interest to collaborate with the UB because we have to create awareness amongst our industries, particularly SME and large corporates and mid corporates, that use electronic platform, digital platform, easy platform, accessible platform to get lot of financial products. And since we are pursuing with the, as you said, Amolji, Ministry of Finance, RBI, all the banks, and particularly to provide credit on time, in time, and affordable credit. So this is our effort. So let us take advantage of the UB platform so that my entrepreneurs will make more business and they will make growth, and of course we will achieve the target of $5 trillion economy in few years. So with this words, I'm thankful to UB and all the panelists to sharing their views, particularly for the digital platform related. And thanks to all the participants. So let us have a lunch and networking together so that we can discuss more about UB and their advantages. Thank you very much.